Welcome to Dollars and Cents, understanding your small business's financial statements presented by the North Central Small Business Development Center at Central Lakes College. In this on-demand training, we will equip you with the essential knowledge and skills to better understand your small business financial statements. In Chapter 1, you will learn how to read and interpret financial statements. Whether you're a new entrepreneur or a seasoned small business owner, you will be able to directly apply the concepts learned today to your business. Hello, my name is Tyler Whitwer, and I am a consultant with North Central SBDC. Chapter 1, How to Read and Interpret Financial Statements. Balance sheet. Definition of a balance sheet: a statement of the assets, liabilities, and capital of a business or other organization at a particular point in time, detailing the balance of income and expenditure over the preceding period. How do we interpret a balance sheet? The balance sheet is usually pulled at the end of the month, showing a financial picture of what a business is worth at that point in time. The balance sheet shows the financial performance based on how much the company owns, the assets, how much the company owes, the liabilities, and the value of the firm, owner's equity, or assets minus liabilities. You'll commonly see the accounting equation, assets equal liabilities plus owner's equity. The balance sheet, as the name suggests, must remain balanced or equal on both sides of the ledger. The left side of the ledger will list the company's assets. Assets are going to include cash, accounts receivable, outstanding bills that customers will pay, inventory, facilities, and equipment. The right side of the ledger will list the company's liabilities, or things that it owes. Liabilities will be accounts payable, bills it needs to pay to its vendors, wages payable, salaries, benefits owed to employees, long-term notes payable, which are outstanding loans which the company is making payments greater than 1 year to pay off, and more. The balance sheet will almost certainly be different at different points in time, but should always balance out. If you do not have a balanced balance sheet, you will need to search for any mistakes made in the preparation of the statement. Most software will automatically produce the statement for you. You'll just need to be able to read it. Having working knowledge of your books will help you find discrepancies in this and most other statements. Here's an example. Because we're looking at the business at a moment in time, we see activity of the firm. Some of that activity means that they have outstanding liabilities or money they owe creditors. For example, if we looked at the balance sheet on payday, wages payable would be $0 because wages have been paid and the next pay period has not yet begun. But if this is true, if liabilities and assets can change depending upon the time period, how can we be sure that the left side of the ledger, assets, will always balance with the right side of the ledger, liabilities? Easy. The answer is owner's equity. Owner's equity simply means the value the owners could extract from the company. Think about it this way. If a firm had $100 in assets and $50 in liabilities, what amount could the owners extract from the business if they closed it today? Well, they would use the $100 in assets to cover the $50 in liabilities, leaving $50 in owner's equity. But what if part of the liabilities had been $10 of wages payable and they were paid? How would that change the balance sheet? Well, likely this would mean cash, an asset used to pay wages, decreased by $10, and wages payable, a liability, decreased by $10. So assets would equal $90, liabilities would equal $40, and owner's equity would still be $50. So, a firm's value is always expressed by the balance sheet, where assets equal liabilities and owner's equity. Below is a simple balance sheet used as an example. For year-end 2020, the company has the following current assets: cash, accounts receivable, and inventory, totaling $46,100. They also have property, plant, and equipment, totaling $100,000, for a total asset value of $146,100. Also in year-end 2020, the company has current liabilities of accounts payable, payroll taxes, and payroll for total current liabilities of $20,500. They also have long-term debt of $98,000, so their total liabilities are $118,500. Knowing the equation of assets equal liabilities plus owner's equity, we can see that the equity of the business must be $27,600 for liabilities and owner's equity to equal the assets of $146,100. Now, let's talk about profit and loss, otherwise known as income statements. A profit and loss statement is a statement that is compiled at the end of a financial year or other period, showing that year or other period's revenue and expense items and indicating gross and net profit or loss. The profit and loss statement is a summary of the business income after expenses are paid. To interpret the income statement, it is an accounting tool that reports a company's financial performance over a specific period of time, providing a summary of the business's revenues and expenses from operations and non-operational activity. The statement will have a similar structure as the balance sheet, typically having 2 columns, but this time you'll be subtracting your expenses from your sales to determine your net income and/or earnings before interest and taxes, EBIT. The top of the income statement will have your gross sales less your cost of goods sold, COGS. You subtract your COGS from sales to determine your gross profit for the year or period of time. At this point, you add back in any additional revenue received, if you have any, and now have calculated your gross revenue. The next step will be to subtract all other operating expenses for the year or period from your total revenue to determine your net profit or EBIT. The income statement can be a very beneficial tool when setting goals for the future or budgeting based on experience. You should make it common practice to look at your income statement at least monthly as a small business to make sure you are on track for your budgeting goals. Now let's talk about cash flow statements. A cash flow statement is a financial statement that shows the amount of cash that came into and out of a company over a particular period of time. By using a statement of cash flows, managers can plan and manage their cash sources and needs from different types of business activities. How do we interpret the cash flow statement? The cash flow statement provides insight into how a business used or received cash during a specific period of time. They are an important financial tool when it comes to value in a company and understanding how it operates. To set up a cash flow statement, you'll start with a starting balance of cash from your income statement in the same accounting period. Next, you will calculate cash flow from operating activities. These operating activities will be either the direct method or the indirect method. The direct method of calculating cash flow from operating activities is a straightforward process that involves taking all of the cash collections from operations and subtracting all of the cash disbursements from operations. This approach lists all of the transactions that resulted in cash paid or received during the reporting period. The indirect method of calculating cash flow from operating activities requires you to start with net income from the income statement and make adjustments to undo the impact of the accruals made during the reporting period. Some of the most common and consistent adjustments include depreciation and amortization. Most companies prefer the indirect method because it is less time-consuming, but the direct method is easier to understand. It requires accounting for each transaction in the reporting period, and this is likely the method you'd use in a smaller business where you have day-to-day operation activities. After calculating cash flows from operating activities, you will need to calculate cash flows from investing activities. This section of the cash flow statement details cash flows related to the buying and selling of long-term assets like properties, facilities, and equipment. Keep in mind that this section only includes investing activities involving free cash, not debt. The last section of the cash flow statement is from financing activities. This includes cash flows from the debt and equity financing. This is the cash flows associated with raising cash and paying back debts to investors and creditors. Once the cash flows from the 3 main types of business activities are accounted for, you can determine the ending balance of cash and cash equivalents for that reporting period. Let's look at the simple example below and walk through each section. Year-end 2020 resulted in net income of $39,600. Accounts receivable is at $8,000. It is negative because you have not received it yet, but will. And I added deferred taxes as an example in case you are not operating as a pass-through business. Total cash from operating is $32,600. The cash for investing for year-end 2020 came in form of equipment at $5,000 and fixed assets, furniture, at $2,500. This means that you went out and purchased some equipment and furniture for the business to help with operations. These investments will be depreciable. The total you spent in cash for investing was $7,500. Now, the cash from financing section holds your mortgage payments of $12,000. This can include many different categories that you may finance, maybe even equipment, but mortgage payments were something that you will likely have. When you add up these sections, you get a total increase in cash of $13,100 for the year end 2020, which means the business has a positive cash flow. We hope that Dollars and Cents has left you with a greater understanding of how to read and use your small business financial statements. If you'd like to continue your learning and meet with a North Central Small Business Development Center consultant, visit the website below or call our regional director. Dollars and Cents, Understanding Your Small Business Financial Statements is presented by the North Central Small Business Development Center at Central Lakes College. The North Central Small Business Development Center is a part of the Minnesota SBDC network. This video is funded by a grant from the Minnesota Department of Employment and Economic Development.